This LOS is described characteristics and risks of commercial mortgage-backed securities. Commercial mortgage-backed securities. Commercial mortgage-backed securities, CMBS, are backed by a pool of commercial mortgages on income-producing property, such as multifamily properties, for example, apartment buildings, office buildings, industrial properties, including warehouses, shopping centers, hotels, and healthcare facilities, for example, senior housing care facilities. The collateral is a pool of commercial loans that originated either to finance a commercial purchase or to refinance a prior mortgage obligation. In the United States and other countries where commercial mortgages are non-recourse loans, the lender can look only to the income-producing property backing the loan for interest payments and principal repayments. If a default occurs, the lender can foreclose the commercial property, but it can only use the proceeds from the sale of that property to recover the principal outstanding, and it has no recourse to the borrower's other assets and/or income for any unpaid balance. The lender must view each property individually, and lenders evaluate each property using measures that have been found useful in assessing credit risk. Two measures that have been found to be key indicators of potential credit performance are 1, the loan-to-value ratio, and 2, the debt service coverage ratio, sometimes referred to as DSCR. The DSC ratio is equal to the property's annual net operating income divided by the debt service, that is, the annual amount of interest payments and principal repayments. The NOI is defined as the rental income reduced by cash operating expenses and a non-cash replacement reserve reflecting the depreciation of the property over time. A DSC ratio that exceeds 1 indicates that the cash flows from the property are sufficient to cover the debt service while maintaining the property in its initial state of repair. The higher the DSC ratio, the more likely it is that the borrower will be able to meet debt servicing requirements from the property's cash flows. Quick practice question to help our understanding. Credit risk is an important consideration for commercial-backed securities, CMBS, if the CMBS are backed by mortgage loans that A, are non-recourse, B, have call protection, or C, have prepayment penalty points. A is correct. Credit risk is an important consideration for commercial mortgage-backed securities if the CMBS are backed by mortgage loans that are A, non-recourse. If a commercial mortgage loans are non-recourse loans, the lender can only look to the income-producing property backing the loan for interest and principal repayment. If there is a default, the lender looks to the proceeds from the sale of the property for repayment and has no recourse against the borrower for any unpaid mortgage loan balance. Call protection and prepayment penalty points protect against prepayment risk. Commercial mortgage-backed securities. Now we're going to look at CMBS structure. Interest on the principal outstanding is paid to all tranches. Losses arising from loan defaults are charged against the outstanding principal balance of the CMBS tranche with the lowest priority. This tranche may not be rated by credit rating agencies. In this case, this unrated tranche is called the first loss piece, residual tranche, or equity tranche. The total loss charge includes the amount previously advanced and the actual loss incurred in the sale of the loan's underlying property. Two characteristics that are usually specific to CMBS structures are the presence of a call protection and a balloon maturity provision. So now we'll look at that call protection. CMBS have considerable call protection, which allows CMBS to trade in the market more like corporate bonds than like residential mortgage-backed securities. This call protection comes in two forms, at the structure level and at the loan level. The level of sequential pay tranches is an example of call protection at the structure level. At the loan level, 4 mechanisms offer investor call protection. 1, prepayment lockouts. 2, prepayment penalty points. 3, yield maintenance charges. And 4, defeasance. And one last practice question to finish this LOS. Which commercial mortgage-backed security characteristic causes a CMBS to trade more like a corporate bond than a residential mortgage-backed security? A, call protection, B, internal credit enhancement, or C, debt service coverage ratio level? A is correct. With CMBS, investors have considerable call protection. An investor in a residential mortgage-backed security is exposed to considerable prepayment risk, but with commercial mortgage-backed security, call protection is available to the investor at the structure and loan level. The call protection results in CMBS trading in the market more like a corporate bond than an RMBS. Both internal credit enhancement and the debt service coverage ratio address credit risk, not prepayment risk. And that's the last slide for this LOS. Thank you.